morning. You're watching Daybreak on Bloomberg Quint Live. I'm Alex Matthew. First, let's look at the headlines. Asian markets trade mixed in early trade after US stock indices rebounded in the last session. The Singapore Stock Exchange says that it will develop its own Indian products after Indian peers snap ties. Brokerages maintain their position on SBI despite a sharp rise in provisioning as analysts bet on stable core business. Hospital and medical chain operator Aster DM Healthcare is looking to raise 960 crore rupees from the primary markets. The IPO opens today. And finally, IRDAI Chairman T.S. Vijayan has told Bloomberg Quint that the government's national insurance plan is challenging but achievable. Turning to international markets now, and US markets ended their worst week in 2 years in the green on Friday. Investors, it seems, were spooked by the fears of more rapidly rising interest rates. This week's US inflation report may be the next catalyst for the tug of war between stocks and bonds that underlies the market turbulence. Bloomberg's Abigail Doolittle wraps up all the US market action in this report.
It was a roller coaster day for stocks in Friday's Wall Street session that ended in a big rebound rally for the major averages. The Dow, S&P 500, and the Nasdaq all climbed by more than 1.4% on the close, but at the lows, the Dow had been down 2%. So a volatile week ended with a volatile day that ended with big gains, but on the week, the three major averages are down for a second week in a row, for the worst weekly drop since January of 2016 for both the S&P 500 and the Dow. In fact, relative to the S&P 500, all 11 of the S&P 500 sectors closed lower. Energy down the most, down 8% in sympathy with oil. WTI crude back below $60 a barrel as the stock sell-off goes cross-asset class. Now, behind the risk asset sell-off is a reversal of overbought and frothy conditions, plus rising rates as the Fed tries to normalize interest rates. But on the week, yields were up just slightly. So that's interesting only because it wasn't the source of pain on the week, more from a macro standpoint. Some of the biggest point drags on the week included Amazon, Microsoft, Facebook, and Alphabet. And that's interesting, too, because it suggests that the selling action is about a shift in sentiment since little has changed for these high-quality companies from, say, 2 weeks ago when we were still in the frothy times, the overbought conditions of January. Now, all attention, of course, is on whether or not this sense of risk-off extends into next week or perhaps whether some sort of stability will be found. From New York, Abigail Doolittle, Bloomberg News.
Well, let's take a look at the Asian markets now. And some of that risk off that Abigail was talking about seems to have slipped into the Asian markets this week. And they've opened mixed after heavy selling pressure last week. The Hang Seng ended the week over 11% lower, and so did the Nikkei, lower than their respective 52-week highs, of course. Let's go across to Bloomberg's Rosalind Chin for more. Morning, Rosalind. Volatility seems to be the name of the game.
Yes, and investors, I think, are pretty much on edge still, just waiting to see what might happen. And we see today that Japan's markets are closed for a public holiday, Japan Foundation Day, so no trading there, thinner volumes. And this is likely to characterize the next week or two because, of course, we are heading towards the Lunar New Year holidays here in Asia. So from Thursday, China will be shut for a week, and we're going to see closures across most of the major markets like Hong Kong, Singapore as well, from Friday and possibly Monday as well. So definitely we're going to be seeing thinner volumes, and that, of course, may affect the impact of any big or major sudden moves that might happen across those days. Now, the MSCI Asia Pacific Index rising 0.4% this hour. I want to look at Hong Kong, South Korea, and of course the Shanghai Composite this hour because of course those markets are trading right now. The Kospi is up by 0.7%. Big movers there, including Samsung, of course, the one that big hitter, of course, POSCO as well, and some of the other tech companies. And in Hong Kong, what's driving that market? IT companies as well, including Tencent Holdings, of course, and some of the financials. AIA Group up by 2.5%, and also Ping An Insurance and HSBC Holdings. Those major markets there, major companies there, helping push the Hang Seng higher by about 0.4% at this point in time. Now, I want to look a little bit at Australia because a Royal Commission has kicked off today. That is an inquiry which is going to be a year long, looking into the financial industry, banks and financial services industry. There have been some scandals coming out of Australia, and the commission, the inquiry, is going to be looking at bank profitability in particular. there's been a lot of anger over bank conduct because there's been evidence of wrongdoing coming out, including, for example, rate rigging and also ripping of customers. And so there's going to be a lot of scrutiny on banks. And we have seen that banks have been affected since this inquiry was announced. Now, the S&P ASX 200 index right now trading lower by 0.6%. And of course, leading that lower is in fact JB Hi-Fi. That's after its profit forecast for the full year fell short of analyst estimates. So that, of course, not adding to any relief to the investors there in Australia as well. And of course, we're looking ahead to that CPI data out of the US this week, which of course could move the markets. That's out on Wednesday. Back to you.
So much for that, Rosalind. Let's move to the Indian markets now, and Jayesh Khilani and Agam Vakil are here to set you up for the day's trade and also to tell you what's happening in the futures and options space. Morning, guys. Jayesh, first to you. What's on your list today?
Morning, Alex. Well, it looks like a mild gap up opening as far as Indian markets are concerned. If you look at the SGX Nifty, that is trading with a positive bias of about 0.3 to 0.2%, just about the 20 to 30 points higher. But if you look at the other markets, how they actually close, so the Dow Jones, we had spoken about that as well, ended about 1.4% higher. But if you look at the low to the high, that was a 1,000 point or a near 1,000 point recovery for the Dow Jones, but the European markets, that actually closed lower about more than 1% each for all of them. So the Euro stocks as well as the FTSE CAC and the DAC, all of them ending about more than 1% lower on the index itself. Now, if you look at the Asian markets, of course, we know that the Japanese market is shut on account of Foundation Day holiday, but Hang Seng has opened with a mild positive bias, and SGX Nifty 2 is trading with a positive bias as well. Now, if you look at some of the charts that we've pulled up on the terminal, not this one, if we can get the other chart that we had on the screen. We had the commodity index. So that's the SGX Nifty, what I was referring to. If you can look at the last bit, that actually started above 10,500, but right now has slipped to about 10,480. But let's look at how the commodity space is actually doing with oil prices being in focus. So oil actually slipped more than 3% and posted its biggest weekly loss since 2016 and slipped below the key 60 per barrel mark for the WTI, and even Brent also slipped below the 65 mark. But in early Asian hours, we are seeing some bit of mild positive come about for oil prices. But let's look at how the metals actually did. The metals index itself closed about 1% lower. Now, if you look at the other base metals which actually declined in trade, so aluminium was your top loser, down about 2%, while we had copper, zinc, nickel and tin which actually slipped more than 1% each, with lead the only base metal that ended higher. And COMEX copper has started trading with a positive bias of about 1%, and you can see that the Shanghai base metals, those two have started about on a negative note, except for steel, which is trading flat in trade. And now let's move on to the other space that we were tracking for you. So that's let's have a look at the flows picture. So we've seen that for this entire month, the DIs have actually been buyers while the FIs have been sellers. So the top panel shows you the DII picture. You can see that the last 5 sessions they have been net buyers, while the India FII provisional number, that shows a contrast of what the DIs have done. So for the month, if you look at it, DIs have bought more than 5,000 crores, while the FIs have sold in excess of about 3,500 odd crores. Moving on to the Indian indices, that how they ended in trade on Friday. That's a 1-month chart for the Nifty Bank, and we have the Sensex as well. The Nifty Bank actually ended about 1.8% lower and was the top loser in trade. As far as other sectors are concerned, we saw that some moves came about for the PSU Bank and the metal index as well. If we can have that chart on the screen. So that's a euro versus euro dollar, but we were looking at the chart that we had for the volatility index. So we've seen a sharp spike up from about 14-15 odd levels to recent times where the volatility has shifted on the higher side, and we've crossed levels of 20 and 22 as well and hit a fresh 52-week high. Now let's have a look at what is the sectoral gainer. So we had the Nifty Metal Index, which was up about 1.3%, and we had the Nifty PSU Bank Index, which was one of the top losers, along with the Nifty Auto as well. Both of them ended about 1% lower. As far as the Nifty contribution is concerned, let's have a look at that also. So Nifty eventually ended lower by about 121 points. What actually dragged the index was the HDFC twins. We had Infosys, ICICI and some others as well, which contributed on the negative side. But with that, Agam, what can we expect from the futures market?
Well, Jayesh, as you put it, we've seen some amount of weakness on the Nifty. However, we're also looking at a positive opening with respect to the SGX. So, given the fact that we did see weakness with well over 7% added in terms of open interest towards fresh shorts, we are just going to have to wait and watch as to what, or rather where we see the Nifty close eventually at the end of the day's trade. It is a truncated week. But moving on to the Nifty Bank futures as well, we've seen further unwinding, and that is unwinding of longs. The India Volatility Index, again, we did see an up move there, again inching back above the mark of 19, and quite naturally the put call ratio of course can continue to remain at the same mark of around 1.09, so nothing much has changed there. What we have seen, however, is more writing around the 10,400 and 500 calls, so which means that a lot of traders out there are not expecting the Nifty to go below these levels. And do remember, this is on a day where we saw the Nifty fall. That's when we've seen more writing coming along the lower level calls, and of course unwinding in the 10,500 put. But that said, Balrampur Chini enters the F&O ban. What also moves out of the F&O ban is Fortis Healthcare, but we're expecting increased activity considering there is so much news around this particular stock. Moving in, we're keeping an eye on Hindustan Zinc, which saw fresh longs building in, and we also have something like an Adani Prices, which saw fresh longs. That said, we're keeping an eye on several other stocks, which will continue to be focused. But overall, of course, it will be the benchmark indices and what they do in going into today's day of trade.
Thanks so much for that, Agam. Let's turn to an update from over the weekend. The Singapore Stock Exchange has decided to drop its own products reflecting Indian markets after its peers decided to stop sharing data. Sajid Mangat is on the phone line with more details there. Sajid, what happens to the single stock futures that were started to trade on the SGX Nifty?
Good morning, Alex. On Friday we saw the entire three exchanges, NSE, BSE and the Metropolitan Stock Exchange, in a joint statement announcing that they would be terminating all the licensing agreement with overseas indices and prevent data vendors from sharing the data with offshore exchanges. As a result of which the entire agreement with SGX Nifty should come to an end in the next 6 months, because that's the contract termination clause which NSE has with SGX. On Sunday evening, SGX came out and informed all the investors who were trading on this platform that it is looking at this termination notice, and it has 6 months before the contract get terminated. And in the meantime, it will look at coming out with new products for the India basket. Remember, SGX Nifty has a huge trading in Singapore, and nearly $9 billion of open interest that exists on the Singapore platform for the Nifty alone. And that would mean that SGX will have to collaborate with National Stock Exchange if it plans to go ahead and bring out any India product on its platform. SGX also on this part said that it is collaborating with National Stock Exchange to look at the GIFT City where the International Stock Exchange is in place. Remember, the entire notification on Friday said that there is an exemption to offering products in that the IFSC, which is International Financial Center, and that would mean that SGX would have to partner with NSE or any other exchange to ensure that it comes out with some product which is viable for its clients and allows continuity of trading and hedging of the portfolio.
Clearly, more developments awaited there in terms of what the Singapore exchanges do end up doing. So we'll have to keep a watch on that, Sajid.
That's right. We had, as of now, for the next 6 months till August 2018, there is going to be a trading which will happen on SGX Nifty. But as you come closer to that timeline, you will see positions getting closed out, and many of the positions and NSE hopes that a lot of that position will migrate back to India, where you have trading available on Nifty futures and stock futures there. HGX had also started the stock futures. It started picking up. It was a slow start, but it did have nearly 30 stocks which had some kind of trading going on those stocks. So even those stocks will be, will cease to trade in the next 1 month, because the exchanges have given them 1 month of grandfathering so that the data vendors can terminate their agreements with their respective exchanges or offshore platforms.
Right. Thanks so much for that, Sajid. Let's move on now to a comment coming in from SBI's head. The decision taken by key exchanges in India to stop sharing of information with Singapore Stock Exchange is not retrograde, according to SBI's chairman Ajay Tyagi. Let's listen in.
Number one, these are the exchanges who have taken this decision, and they've come out with this joint communique in terms of, I think, in terms of the business interest. And what they are saying, as I read it, is that they want that liquidity on those indices in India should not be actually split, and it doesn't shift abroad. So these are commercial decisions which they are taking. I don't think so it is retrograde, but they are trying to ensure that liquidity in those indices stay in the country. So I don't really say it is retrograde.
SEBI Chairman Ajay Tyagi there. Let's take a check on the rupee and the bond market now, and Saloni Dhanuka has all the updates in those two markets. Morning, Saloni.
Good morning, Alex. So the rupee on Friday weakened to fresh 2-month low at 64.40 levels against the dollar. Now the home currency extended losses for the second straight week. It was down about 34 paise against the dollar, or 0.5% lower. Now, meanwhile, a rally in India's foreign exchange reserves continued for a 6th straight week in a row, and it touched a record high mark of $421 billion mark for the week ended 2nd Feb. While all eyes will be on the CPI and industrial production data back home today. On the global front, dollar index ended higher near 90.45 levels on Friday, and it was up over 1.1% last week. Speaking of the debt market, bonds logged their first weekly advance in a month as yields dropped 7 basis points last week to 7.49%. While lastly, coming back home, dollar rupee is trading at 64.22 levels against the dollar in the non-deliverable forward market, which indicates a positive opening for Indian rupee in today's trade, Alex.
That's Saloni. Let's turn to an IPO that we have to tell you about. Aster DM Healthcare is looking to raise 980 crore rupees from the primary market. The IPO opens for subscription today. Somit Sarkar is here with all the details here. Somit, what are we to look at?
So Aster DM is the 5th IPO of 2018, and this is the largest so far that we have seen. Now, the company is looking to raise as much as 980 crore rupees at a price band of 180 to 190, and at the upper end of the price band, that is 190, the company will be valued at close to 9,600 crore rupees. Now the IPO is a combination of offer for sale and a fresh issue. Now in offer for sale, the promoter is selling shares worth 255 crore rupees, while the company is raising 725 crore rupees as a fresh issue to repay debt worth 564 crore rupees and to purchase medical equipments worth 110 crore rupees. Now if you see, Aster DM is one of the largest private healthcare service provider in 3 regions, that is Middle East, India and Philippines. Now if you see, over a period of time, the company generates most of its revenue from GCC states, that is the Middle East or the Arab states, but over a period of time it has increased the share of India revenue to its total revenue. Now from in FY15, 11% it used to get from India, while as of first half of financial year 2018 it got close to 19% of its total revenue from India. Now if you see, it operates in 3 different segments, that is hospitals, clinics and pharmacies. Now it gets 49% of its revenue from hospitals, 26% from clinics and 25% from pharmacies and other sources. Now it operates around in 23 operating facilities in 9 countries, which includes 19 hospitals which have a total bed of around 4,754 beds as of first half of financial year 2018. Now the company is looking to add in or expand 10 of its hospitals, which will add approximately 1,727 beds to its total beds. Now if you see, Aster DM has a bunch of listed peers, but Apollo Hospitals and Fortis are the nearby peer given the size of the company. Now, Aster's revenue, net profit and EBITDA grew at a CAGR of 32.5%, 21.3% and 6.8%. Now, the revenue growth rate and net profit are better than its peer, but it is a bit inconsistent because in the financial year 2016, the company had suffered a loss, and in financial year 2017, the company saw a profit because of an exceptional gain of 596 crore rupees. As of first half of financial year 2018, the company is having a loss on its profit and loss account, that is Aster DM. Now, if you see the EBITDA growth rate, that is Apollo has a better EBITDA growth rate than that of Aster DM. On the return ratio side, the return ratios of the company are not that impressive. The return on equity is around 10.6%, return on capital employed is 0.2%, while return on asset is just 2.9%. On the hospital business side, if you see, the company's occupancy rate is the lowest among the peers. It stands at around 60%, while that of Apollo and Fortis stands at 64 and 75%. Also, the company's average revenue per occupied bed per day is close to 1,52,000. Lastly, on the valuation side, if you see, on the price to earnings, the company's price to earnings is 48.3%, which is a bit expensive when you compare with Fortis Healthcare. And on market cap to sales, it is cheaper when compared to Apollo Hospitals and Fortis. But on EV to EBITDA and price to book, which are a more important metrics for a hospital business, the shares are offered at an expensive valuation as compared to Apollo Hospitals and Fortis Healthcare.
Thanks for that, Somit. Well, if you missed any of those numbers, you can find it on a story on the website. Somit's done a story that's quite comprehensive, so you can check that out. But let's go straight to the big earnings that came post-market hours on Friday. The big surprise was, of course, State Bank of India. It reported a loss for the first time in 17 years in the December quarter. The surprising number was due to lower income from treasury operations and higher provisioning for NPAs. While asset quality for the bank deteriorated, what stood out was the divergence between the bank's classification of bad loans with the RBI's assessment. That number stood at over 23,000 crore rupees. Let's take a look at what the brokerages are making of SBI's December quarter numbers. Shraddha Babla has all the details here. Shraddha?
Well, yes, Alex, so brokerages have taken into account the weak third quarter numbers and also the 8,800 crores of capital infusion that they have received under the government's PSU bank recap plan, and accordingly they have tweaked their estimates and target prices. Broadly, it's a mixed picture because some have retained their target prices while the others have trimmed it by up to 10%. Starting off with Motilal Oswal, they maintained a buy but trimmed the target price from 415 to 375. They said that the asset quality has disappointed, but they do expect gradual recovery over FY19. They've said that the core portfolio performance remains healthy, but purging of the residual stress assets will remain an overhang on the stock in the near term. That's what they expect. And they've cut their FY18, 19 and 20 earnings estimates by 75, 20 and 22%. Axis Capital has again maintained a buy but lowered the target price to 350 from 380. They've trimmed the FY18-19 estimates by 20 to 60%, and on the back of that, the adjusted book values are now lower by 20%. But they have said that they will be tracking deliverables on growth, recoveries, and write back of provisions from LCLT cases, all of which may give some sort of an upside to their estimates. JP Morgan, they've retained a neutral with a target price of 320. Again, on the back of the weak set of numbers, they expect that to remain an overhang on the stock price in the near term. Edelweiss has maintained a buy. Now, they have actually hiked the target price from 399 to 420. They've said that the positive asset quality surprise in the second quarter, slippages in this quarter have risen back to 5.7%. But overall, the stressed assets were still contained at 30%. Why is that so? Because most of the slippages have come from within the stressed pool itself. But they've lowered the estimates by 65% and 16% for FY18 and 19. But they do believe that government's recap allocation will cushion asset quality swings and arrest net worth erosion. Hence, they are revising their target price slightly higher. So broadly, some of them have cut their target prices, and we could expect to see a lower opening for SBI today.
Clearly one of the stocks to watch for, but a lot of more earnings to tell you about. With regard to Tata Steel, it's been an operationally strong quarter for the steel maker this December quarter, with revenue jumping 21%. The EBITDA rose by 57%. Nikki Mirchandani has more details here. Nikki, what are the key highlights?
So it's an operationally strong quarter that we're looking at for Tata Steel. Indian business has been a beat. There seems to be they came in a bit disappointment from the European operations. As net profit grew multifold to a number of around 1,294 odd crore as compared to a figure of nearly 243 crore in the corresponding quarter. And volumes have risen 8% year-on-year basis on a consolidated basis to a number of 6.56 MT. If you look at the Indian steel business, the Q3 EBITDA per ton at 14,024 has been the highest in nearly 12 quarters. Volume has given a 10% boost just in terms of the Indian steel business at a number of 3.3 million ton as against 2.9 million ton that's been in the corresponding quarter. Now, Macquarie on Tata Steel has upgraded this counter to outperform from underperform and has raised the target price substantially to 800 rupees from 572 earlier. It says that the EBITDA has above estimates EBITDA led by strong margins in India, and that has been partially offset by the weak margins in Europe though. But then it says that it's a strong re-rating candidate based on the back of a stronger balance sheet performance, focus on domestic growth. These are the two factors which have warranted a re-rating. JP Morgan also pretty much has maintained the rating, which is an overweight, and has said it's the highest ever India EBITDA that the company could log in multi-quarters now. It does say that the Q4 margins are expected to be higher, but then the volumes going forward in the next quarter could see marginal impact coming in.
Thanks, Nikki, for that. From the oil and gas space, ONGC reported a weak December quarter. Net profit came in slightly lower while realizations were flat. Somit Sarkar is back with the details. Somit, what are the highlights that you have?
So if you see, ONGC reported a weak set of numbers. It was a miss on all fronts, that is revenue, EBITDA and net profit. If you see the headline numbers, revenue was up by around 21% to close to 23,000 crore rupees, while net profit was down by 2.3%. Now EBITDA was up by around 20% to 10,919 crore rupees, while margins contracted to 47.5% versus 48.2% reported by the company in the last quarter. On the operation side, the net realization came in at $60.58 per barrel versus $51.2 per barrel reported by the company in the last quarter, while crude oil production was down by 2%. Gas production remained flat at 6.277 billion cubic meters. So what led to this? It was a fall in crude oil production, flat gas production and marginally lower than expected crude oil realization, which led to this miss. Now crude oil realization came in at $60.58 per barrel, whereas analysts were going with a number of close to $61.4 per barrel. On the financials, along with the operational miss, it was the higher cost, lower other income which impacted the quarter. Now if you see, the other income was lower by around 42% compared to the last quarter, while the tax expense was marginally higher in this quarter. On the exploration cost, it surged by around 20% due to higher exploratory drilling expenditures, while depreciation was higher by around 21% due to higher depletion expenses. Other expenses was also higher by 26% due to higher workover expenses in the third quarter of financial year 2018.
Thanks so much for that, Somit. Now, Shraddha Babla has all the stocks and news that you have to watch out for. Shraddha, apart from the ones that we've already talked about, what's on your list?
Well, to start off with, ONGC, despite having discussed that, ONGC, Videsh-led Indian consortium, which comprises of ONGC, Videsh, IOC and BPCL's Bharat Petro Resources, they will acquire a 10% stake in offshore Abu Dhabi concession for $600 million. Good news as far as Cadila Healthcare is concerned. The company's Muraya facility was inspected by the US FDA recently with no observations. Similar is the case with Ajanta Pharma, where the formulation-based facility in Dahej was inspected with no Form 483 observations, so some relief coming in there. Dredging Corp has secured a 31 crore contract, so you could see some marginal reaction there. You have Business Standard, which has said that Liberty House has submitted a revised bid for Amtech Auto after earlier bids were rejected because they were way below the reserve price of 40 billion. So keep an eye out on Amtech Auto. And lastly, we're also tracking Awadh Sugar and Energy on the back of a bulk deal on Friday, where investor Anil Kumar Goel bought 0.5% stake. The stock already, I believe, ended about 10 to 13% higher yesterday, but you could see some more upside here. So those are some of the stocks to watch, Alex.
Thanks so much for that, Shraddha. Let's move on to a quick interview that we have for you. IRDA Chairman T.S. Vijayan says private equity players are likely to invest in the insurance space. In a conversation with Bloomberg Quint's Ridhima Saxena, Vijayan also said that the prospect of a national healthcare scheme is very exciting. However, the implementation will be crucial. Listen in.
I think it will happen. It will happen. because one thing about a private equity is they are putting money and after some time they take out. This is the nature of it. They must be looking for opportunities on it. I'm sure it's somebody will be coming up fast.
Sure, sir. Also, one other thing that there has been a lot of talk about is the National Health Protection Scheme. So,
yes, which Finance Minister announced.
Correct.
Yeah.
So, after Pradhan Mantri Fasal Bima Yojana, this would be the second biggest scheme at such a large scale that will or may see implementation going forward. So, how has been the experience with crop insurance scheme, and how do you think National Health Protection Scheme will be implemented?
See, National Health Protection Scheme, probably you can compare with the Prime Minister's Jeevan Jyoti Bima Yojana, Bima Suraksha Yojana. That's for individuals, not for crop it is coming. This is for individual and the families. The government has announced for 10 crore. Quite exciting. That's what I heard it. I said, I mean, anybody who is working with insurance, we had some inkling on that thing even before that. It's quite exciting news. Implementation will be a challenge because 10 crore families are to be enrolled into that thing. 50 crore people are coming. Big outlay is there. However, we had an experience of running Rashtra Swasthya Bima Yojana. A very smaller level. Some states are having some insurance schemes. Some degree of expertise is there in that thing, and on the base of this expertise, I think it will be achievable target.
Well, that's all we have time for on this edition of Daybreak. But all you need to know is up next, so do stay tuned. Thanks for watching. This is Bloomberg Quint.